Hello everyone. This is in continuation of our topic marginal costing. This is the fourth part. Question number 5. You are given the following data for 2 years, 2010 and 2011, sales as well as profit. We are supposed to calculate PV ratio, break-even point, profit when sales are rupees 1,80,000 and sales required to earn a profit of rupees 1,20,000. Finally, we have to find the margin of safety in the year 2011. First one, PV ratio. Since sales as well as profit is available for both the years, we can find out PV ratio by calculating change in the profit divided by change in the sales. So change in profit is 13,000 minus 8,000 divided by 14,000, sorry, 1.4 lakhs minus 1.2 lakhs. So that will give us 5,000 divided by 20,000, which in terms of percentage will be 25%. The next one is break even. To calculate break even, we need to calculate the fixed cost. So we have sales available, profit available, PV ratio just now we calculated, we can find out the fixed cost. Means sales is equal to fixed cost plus profit divided by PV ratio. Means let us consider the 2011 sales, 1,40,000 is equated to fixed cost, which we have to find, plus profit is known to be 13,000. PV ratio just now we calculated, it is 0.25. Cross multiplying, we will have fixed cost is equal to 1,40,000 multiplied by 0.25 minus 13,000. If we calculate, we will get the fixed cost as 22,000. Now let us calculate the break-even point. Break-even sales is equal to fixed cost divided by PV ratio, which is 22,000 divided by 0.25. So we will get the break-even sales as rupees 88,000. Third part of the question. You have to find out what is the profit when sales are 1 lakh rupees 1,80,000. Sales is equal to same formula, fixed cost plus profit divided by PV ratio. Sales is given in this as 1,80,000. Fixed cost, just now we calculated it is 22,000. We need to find out the profit. PV ratio is known to be 0.25. Again, cross multiplying, we will have profit is equal to 1,80,000 multiplied by 0.25 minus 22,000. We calculate, we get the break even, sorry, we get the profit as rupees 23,000. Fourth part of the question. Sales required to earn a profit of rupees 1,20,000. Again, using the same formula. Sales equal to fixed cost, we know it is 22,000. To get a profit of 1,20,000, divided by PV ratio. us calculate that. Get that much of profit, we need to do a sale of rupees 568,000. Then MOS, margin of safety, is equal to profit, margin of safety for the year 2001, 2011. So the profit divided by PV ratio. Profit for that year is given as 13,000 divided by PV ratio is 0.25, which means this works out to rupees 52,000. So that is the solution for this question. Let us move on to the next question. Question 6. A, B, and C are three similar plants under the same management. Who wants them to be merged for a better operation? The details are as under. Plant A, B, C they give. Capacity operated by plant A is 100%, B is 70%, C is 50%. All the figures are given in lakhs of rupees. Turnover, which is sales turnover, variable cost and fixed cost, that is being given for each of the plant. Find out the capacity of the merged plant for break even. Number 2, profit at 75% capacity of the merged plant. Third one, turnover for the merged plant to give a profit of rupees 28 lakhs. So we need to first convert all these plants before merging all these plants. What will be the situation if it is converted to 100%? Means, for example, sales turnover, if you do it for what do you call 70%, we are getting in before that, A, we need not do any conversion. We are keeping the same figure, sales as 300, variable cost as 200, and fixed cost as 70. So let us calculate this profit. This will be 100, and then profit will be 30. Now, coming to B, here 280 is for 70%. So what will be for 100%? So 280 by 70 into 100. That will give us 400. Then here 210 by 70 into 100. That will give us 300. So contribution will be 100 here. And the profit 100 minus 50, we get 50. For plant C, it is 50%. So it will be double, means whatever is given figures, it will be double except for the fixed cost. That's why fixed cost, I wrote the same figures, 70, 50, and 62. There will not be any change. Whereas turnover and the variable cost will change. So 150 will become 300. 75 will become 150. So the contribution will be 300 minus 150. So it is 150. So this will be 8 and 88. Now for the merged one, it will be 1000. Adding all the sales turnover, 300 plus 400 plus 300. Here 500 plus 150, 650. Contribution will be 350. Fixed cost, let us add 120 plus 62, 182. So if we subtract, we get 8, 6, 1. So 168 will be the profit for the merged one. Now, what is the first question? Capacity of the merged plant for break even. Let us calculate first the break even. Break even sales equal to fixed cost divided by PV ratio. So that means we need to first calculate the PV ratio. This is nothing but contribution by sales into 100. So here we calculated contribution as 350. Sales for the merged one is 1000 into 100, which means it is 35% or 0.35. So here fixed cost is 182 divided by PV ratio is 0.35. So if we calculate, we get 520. So that is the break-even sales. Therefore, capacity for a break-even sales should be 520 divided by 1000 multiplied by 100, which is 52% capacity. If the merged plant runs, it will break even. The second question, the profit at 75% capacity of the merged plant. So sales for a 75% capacity will be 0.75 times 1000, which will be 750. So now we know sales is equal to fixed cost plus profit divided by PV ratio. That means 750 is equal to, fixed cost is known to be 182. Here, fixed cost is 182 plus profit divided by PV ratio. We calculated as 0.35. Cross multiplying, we get the profit as 750 multiplied by 0.35 minus 182. That will give you 80.5. Third part of the question, the turnover from the merged plant to give a profit of rupees 28 lakhs. Means we need to calculate what will be the sales. So sales, same formula, fixed cost known to be 182. Profit is given in the question as 28 lakhs to 28 divided by 0.35. If we calculate this, we will get 600 as the sales. So that is the solution for this particular question.